Hi guys, welcome to Accounting with Naomi. In this class today, I'll be working on IFRS 15, revenue from contract with customers. Let's go into it. Right, what does IFRS 15 entails? All right, looking at from the standard, this standard establishes the principle that an entity must apply to report useful information about the nature, the amount, the timing, and the identity of revenue and cash flows arising from contract with customers to users of financial statement. All right. So most important thing, let's first of all understand what you're dealing with. Understand what is these particular standards entail. Now have a picture of this in your mind. It makes it easy when you begin to work with it. All right, let's go. Now let's look at IFRS 15. What do I really want to understand here? The most important thing that I want to understand is recognition of revenue. And to be able to recognize revenue, one has to go through 5 steps. All right. So there are 5 steps of revenue recognition. Okay. And what entails on these 5 steps? Let's go in detail. Right. So step number 1, right? Very first thing is identify the contract. What is the contract? Okay. What is the type of contract that you're looking for? Right. And does the contract have any effect of modification? Does it have extensions? All right. What are the benefits that comes with the contract? Okay. So that's step 1. Now, once I identify the contract and I know what I'm doing, then I go to step 2. Right. Now, step 2, we're looking at identifying the performance obligations. The performance obligations. Now, wait, hold on. Before we go ahead, what are performance obligations? All right. So, performance obligation, these are promises in a contract to transfer to a customer goods or services that are distinct, that is individually, or series of distinct goods or services that are substantially the same and have the same pattern of transfer. So now when we say the product is distinct, we mean it can be sold on its own, right? So if it can be sold on its own, it's distinct. Otherwise, it can be sold with other products or other services. That's what we're saying. It's a series of distinct goods or services. So that is performance obligation. In other words, what exactly is this about? What exactly are you selling? Or what services exactly are you rendering? Now, it can be one service or one product that you're selling, or it could be a bundle of products or services all together. All right. So that's what performance obligation is. Now, please take note, this step is very important. If you don't know what you're selling, then what's the point? Let's continue. Right. So step number 3. Very important step, determine the transaction price. Oh my goodness. I mean, why are we running business if we are not going to get any cash from it? If there's no profit, what's the point? All right, so let's determine the transaction price. Now, the transaction price, guys, is your selling price. That is your selling price. Okay. Now, your selling price can come in different ways. There are different ways that we can calculate the selling price. We can base it on the cost price using the markup percentage or the gross profit percentage to calculate the selling price. So they can either give you the cost price, they give you the markup percentage, gross profit to calculate the selling price. All right. Or they can give you the price per unit and give you how many units were sold. So you can use that to calculate the selling price, which is your transaction price. Please take into note that there may be existence of financing components. In other words, I'm talking about time value of money. A situation where a client pays us maybe 6 months after or 12 months after, the company could consider charging interest on it. We can charge interest on it by using discount rates. So in other words, you would have to then calculate the present value. All right. So the future value would be the amount they have to pay in the future, right? The total selling price will be the future value. And then now currently, as we are doing our financials, as we are closing our books, we then have to calculate present value. So you need to look out for the discount rate. Please keep in mind there's a possibility of an existence of financing component. All right. Now, in terms of transaction price, again, there could be a transaction price that has non-cash consideration. All right. For example, if we are exchanging products. So if I give you my shoes and in result, you give me your belt. So how do we then recognize, how do we then know the transaction price? Because there is no money involved here. All right. So remember, I give you my shoes, you give me your belt. So the transaction price will be the fair value of what we are receiving. In this situation, the belt. So the belt that I'm receiving, I'll take the fair value of the belt as my transaction price. Now, it may happen that the transaction price is not possible to obtain it. We don't have enough information to obtain the fair value. The fair value of the belt is not possible, or we don't have enough information to obtain it. Then the other possibility will be, only if we are not able to get the fair value of the belt, the other possibility will go back to what I'm giving now. The product I'm giving, which is my shoes, I'll then go back to the standalone selling price of the shoes. That becomes the transaction price. All right, please take that into consideration. Remember, we need to know how much are we selling this for. Okay, so after that, after we have determined that, we then go to step number 4. Right, here now we are saying, now allocate the transaction price to the performance obligation. Now remember, you can have more than one performance obligation. We can have one performance obligation. Whichever the case is, allocate your transaction price. If it's only one product, it's very easy, okay? Whatever the product is, the transaction price fully belongs to it. But when I have more than one performance obligation, then I will have to apportion accordingly. All right, how much of these transaction price belongs to each of the products, especially if you're selling them as a package. Now remember, the package price will always be the transaction price. Each individual item may have its own standalone selling prices, which we'll use for us to be able to get the proportion that we'll use to calculate out of the total package price, which is the transaction price, and know how much of the transaction price belongs to each of the performance obligation. Now, believe me, this step is the most important step, especially if you have a lot of performance obligation. This step is very, very important. All right, once you are able to do that, once you're able to allocate the transaction price to the separate performance obligation, once you're able to do that, then we go to the last step. And now we are closing it off. All right, so we want to close it off. The last step now, step number 5, this is where we now recognize the revenue. Yay! So if you have reached here, then you are saying that I have done it. In other words, you're ticking the boxes. All right, but wait, hold on. To recognize revenue, we only recognize revenue when or as the entity satisfies a performance obligation. Whoa, what does that mean? Right, so we spoke about performance obligation in step number 2, right? So these are either the product you're selling or the services you're rendering. Okay, so we only recognize revenue once that performance obligation is satisfied. In other words, the customer obtained control of the product. In other words, if it's a product, did we deliver the product to the customer? Do they have control of it? Okay, it could be put in different factors depending on company policy. So other company policy could be you only obtain control once you've made payment. Others, you could make payments. You could have the product first and make the payment later. So it depends on your policy. All right, but the customer must have the product for us to say performance obligation is satisfied because they have control. Okay. Or the services, right? If we're also providing a service, the customer must have benefited from the service before we can say control is obtained. All right, so control needs to be obtained for us to say performance obligation was satisfied. Now, there are 2 ways that performance obligation can be satisfied, right? It is either over time or at a point in time. All right, now what does it mean? Please listen carefully. Let's say, for example, you have registered for tutorials with accounting with Naomi, and Naomi is teaching you for 6 months. All right. So for these 6 months, if I teach you for maybe 2 months and my year end, I get to year end by 2 months, I can recognize revenue for the 2 months that I've already taught you. So you got your tutorials for 2 months, and by year end, I can recognize that and then recognize the rest as we go. So over time means I can do it portion by portion, but at a point in time, it means I'm doing it when the time reaches. Okay, so that's how it happens. Right, so that's how you recognize your revenue. And then we go on to other considerations. All right, there are other considerations that you need to know as well. Apart from the steps, all right, there are other contracts that you need to understand. For example, a sale with the right of return. Okay, you find this also in IFRS 15, paragraph 55. Right, this is a picture illustration of what happens here. So what am I saying? I have sold you an item, but I allow you to return the item, right, for a specific period. Let's say you're not happy with the product, or whatever the case is. Maybe it's damaged, or it's not giving you the quality that you expected. All right, whatever reason it could be. So the company will give you time. If they say company gives you time, maybe within 30 days or within 3 months, you are allowed to return the product, right? The problem with that is that we cannot go ahead to recognize the revenue because we have given the person the right to return the product. All right. So until that time lapses, or until that time expires, we cannot recognize revenue. However, there's another solution. If we are able to come up with an estimate, to say, from the past experience, maybe 90% will not return the product, we can then rely on the 90% and recognize revenue now with the 90%. Okay. And then only the 10% will then have to create an account called a refund liability. Okay. So create an account called refund liability, right, which is the estimated portion expected to be returned, right? It's a liability account. And then also we're also going to have a corresponding asset account, which we call right to recover. All right, this is also, it's an adjustment to the cost of sales. So this is an adjustment to the cost of sales, and then the refund liability is an adjustment to the revenue. Okay, so basically it's that portion, that 10% that is going to be returned for revenue is going to be refund liability. Then the 10% now to adjust my cost of sale is going to be right to recover assets. All right, so that's how it works. Remember, whenever you're accounting for your revenue, there's what you call matching concept, right? So if I recognize revenue, I must also recognize corresponding cost of sales, all right, and the effect of it. So that is it, guys. That is sell with the right of return. So in case you come up with such a contract, just know that that's how you deal with it. Only recognize revenue after the time expires, or in a situation where you have an estimate, you can then recognize the portion of estimates, estimated items that you don't expect to be returned as revenue, and the remaining portion as refund liability. All right, so that's how it works. Then we have other contract as well that you need to consider. All right, I'm going to talk about two things. First of all, principal versus agent consideration, as well as a consignment arrangement. So they work hand in hand. Right, so we need to, first of all, in a situation where let's start with the consignment arrangement. Consignment arrangement, this is when an entity delivers a product to another party, right, e.g. a dealer or a distributor, for sale to the end customers. As you can see the illustration here, we have, principal, right? So that's where it comes, principal versus agent. So we have the principal who's responsible for the goods and services. In other words, they are the owners. They are the one that owns the goods and the services, all right? And then we have the agent who arranges the sale. So this type of contract is called a consignment arrangement, right? Where the agent is basically, selling on behalf of the principal. Okay, now there are other considerations that we need to understand. Okay, so for the principal, when we are counting for revenue, we recognize the gross amount. The full gross amount is recognized as revenue under the books of the principal company or the principal entity. Right, under the books of the agent entity, we only recognize the agent fee or the commission. So our revenue amount will only be the agent fee or the commission. All right, so how do we then know that this particular entity is an agent? What are the indicators? Now, listen carefully. Right, so the indicators are another party is primarily responsible for fulfilling the contract. So if another party or an entity is primarily responsible for fulfilling the contract, then this is an agent. All right, number two, if the entity does not have inventory risk, right, rather either during shipping or when returned, then it's an agent company. All right, number three, if the entity cannot determine prices for the other party's goods or services, then it is an agent. So an agent does not determine prices, it sells it to the price as it was told to. All right, number four, if the entity's consideration is in the form of a commission or an agent fee. Remember, not the full amount, only that particular thing actually being paid for their service. Right, number 5. If the entity is not exposed to credit risk. So if customers decide not to pay, it's not your problem. Remember, you're only providing a service. All right. So that is the principal versus the agent principle that you need to understand, and which goes hand in hand with what we call a consignment arrangement. So a consignment arrangement happens like this. But how in a consignment arrangement, we need to now know, when do you recognize revenue? Remember step 5, we recognize revenue when performance obligation is satisfied, or when entity satisfies performance obligation, which is either over time or at a point in time. All right. So what does this mean? In the consignment arrangement, the revenue will only be recognized once the customer actually buys the product. So the third party is the customer. So if the customer buys the product and obtains control, then only can all of these people, that meaning the agent and the principal, both of them can then recognize revenue only when the customer obtains control of the product. So it is not when the principal delivers the product to the agent. It is when the customer obtains control of the product. That's when you can then go ahead and say the performance obligation was satisfied. All right. Let's look at one more consideration under revenue. Bill and hold, like literally bill and then hold, like literally. Right, let's explain. What does this mean? A bill and hold arrangement, this is a contract under which an entity bills a customer for a product, but the entity retains physical possession of the product until it is transferred to the customer at a point in time in the future. All right, so what are they saying? So for example, if a customer, let's say, decides to, let's say you want to create a hair salon, and then you have all the products, so you go to the wholesaler and make your order. So you order all the products and everything you need for your hair salon, and then also you have arranged for the place. All right, so you sign for a lease contract of the place, and then you are told maybe at the end of this month you can move in. All right, so you made arrangements and your products are ready. Your products are ready. It is done. It's ready for delivery. But now what happened is the lessor or the owner of the property then comes to inform you that no, you cannot move. Maybe an accident happened or something happened. Maybe there was a leakage or something, and we still need to fix it. So you cannot move in this month end. You can only move in next month end. So what happened is you probably don't have enough storage where you can keep those products. So you can come back now and tell, you can now come back and say, okay, you know what, please hold these items for me. Right, I'm paying, I've made my payment, but please hold the items for me because I do not have the storage space for it. I'm only going to get it next month. Right, because that's the only time you can move in. That is the situation we are talking about here. That is a bill and hold arrangement. The products are ready, they're ready to be delivered, and the money has been paid, but it cannot be delivered because of circumstances like that. For example, storage spaces. All right, so what then happens? Can I go ahead and recognize revenue? Remember what we said, revenue must be recognized only when the performance obligation has been satisfied. All right, so then what can we say about this? Now, there are criteria that needs to be met before I can recognize revenue under a bill and hold arrangement. All right, criteria number 1. The reason for the bill and hold arrangement must be substantial, meaning the customer should be the one who arranges for it. So it should not be us suggesting, it should be the customer. All right, that is number 1 criteria. The second criteria, or rather condition, is that the product must be identified separately as belonging to the customer. All right, so we need to identify it, maybe mark it to say that this one has already been paid off by whatever clients. All right, then criteria number 3 is that the product currently must be ready for physical transfer to the customer. In other words, if we were manufacturing it, it must have been completed, it must have been sealed or packaged or whatever the case is. In other words, if the client comes right now, they can get the product. All right. And criteria number 4, which is last. The entity cannot have the ability to use the product or direct it to another customer. If we are able to sell that product to somebody else, then it cannot qualify to be recognized yet, because we are talking about performance obligation here. So if another customer can buy this, or if us ourselves, the company, can use it again, then it will not be qualified as being satisfied, the performance obligation. All right. So all of the 4 criteria must be met, not one of them, not 2, all 4 must be met before we can say, yes, this can be recognized as revenue, even though the customer has not really gotten the product, but we can recognize it as revenue as long as these 4 criteria are met. All right, guys, that's revenue. Revenue is as simple as this. Look out, don't go very far. Don't go very far. Part 2 is coming, where I'm going to now work through a question together with you to show you how to reason through these steps and also how to apply this contract. So stay tuned. Now, please make sure you like this video. Share the links with everybody you know. Let people talk about accounting with Naomi. Let people talk about us. Share the links, talk about us, like the video, comment. Tell us more videos, suggest more videos that we can do for you. How best can we help you? Most important, don't forget to subscribe. All right. Also hit the notification button so you can get videos, be the first to know about our videos. Right, guys. Thank you so much. I'll see you on the next video. Bye.